As a passive investor, if you are considering to invest in securities that are offered only to accredited investors, you will be required to prove your accreditation status. So let's find out the criteria to qualify for accreditation and why some investments are only limited to accredited investors. Who is an accredited investor? So an accredited investor is a certain investor status, and it's not really a certificate or a diploma that you can earn. Accredited investor is a term that is coined by SEC, which is the Securities and Exchange Commission, and there are some credentials that define how one can qualify as an accredited investor. Now in the US, the term accredited investor is used by the SEC under Regulation D to refer to investors, individual or business entities who are financially sophisticated and have a reduced need for the protection provided by regulatory disclosure filings. Now, these accredited investors include high net worth individuals, companies, insurance companies, brokers, trusts, etc. So an accredited investor is allowed to trade securities that may not be registered with financial authorities, and accredited investors are entitled to this privileged access by satisfying at least one of the requirements that those are regarding their income, their net worth, asset size, governance status, or their professional experience. So the first hurdle that you need to meet in order to qualify for accreditation is income, meaning earned income, which could be from your W-2 job or passive income coming from your rental properties or dividends or interest, etc. What does not qualify is capital gain. For instance, if you were to sell your house and you made $200,000, that is considered as capital gain and does not qualify under earned income. So the earned income hurdle as an individual is the income over $200,000 or over $300,000 if you file jointly with your spouse or partner in each of the prior 2 years. And you're reasonably expecting the same amount for the current year. Now, you can only have one of these two, which means either qualifying for earning over $200,000 as an individual for the past 2 years or over $300,000 with your spouse. You cannot claim both, or you cannot mix and match. So the second hurdle here is net worth. So you need to prove that your net worth is about a certain number. This is adding all your assets, for example, cash in your bank, your retirement account, or other assets or investments. Of course, you cannot add your primary residence when you're calculating your net worth. So briefly, adding up all your assets and then subtracting any debt, which is any kind of loans or credit card debt or other liabilities. Now, if your net worth is about $1 million, excluding your primary residence individually or along with your spouse or partner, you qualify as an accredited investor. The third criteria here is a little uncommon, but if you are an executive or a general partner, a director, or an owner of a company that is issuing securities, you can invest in the security as an accredited investor since you are an officer of that company. The fourth criteria is also pretty uncommon. So for people who have a certain type of professional licenses or certifications like FINRA Series 7, 62, 65, etc., can also act as an accredited investor. Now, there are some additional very rare scenarios for someone, let's say, managing a trust, which has more than $5 million in assets, then they could qualify as an accredited investor. Now, you may ask, why do these unregistered securities exist in the first place? Yes, I know it's a valid question, because these unregistered securities are considered inherently pretty risky, and they do lack the normal disclosure that comes with an SEC registration. They are pretty complex and they are sophisticated type of security. So Many companies who do decide to offer these type of unregistered securities can do so directly to only accredited investors. Now, because this decision allows these companies exemption from registering their securities with the SEC, it can actually save them a lot of money, and that's one of the major drivers. Now, since these sellers of unregistered securities are selling to only accredited investors, it is deemed okay, since this class of investors are financially sophisticated enough to bear the risks. So this type of share offering, which is in reference to unregistered securities, is called private placement. And it is the potential of this type of a placement to be presented to investors with a good amount of risk. Therefore, authorities need to ensure that these investors are financially stable, they're experienced, and they're pretty knowledgeable about the risky ventures. What are some of these unregistered type of offerings, right? So some examples would be commercial real estate deals, real estate development, it could be venture capital deals, hedge funds, angel investments, deals which are highly complex and risky and speculative. These are some of the examples of these type of offerings. Now, the issuer of these type of securities obviously have to ask the applicants to respond to a questionnaire in order to determine whether the applicant is for sure an accredited investor. So the questionnaires might require various types of attachment like your account information, financial statements, even balance sheets to verify the qualification. They could also ask for your tax returns, W-2 forms, salary slips, even letters from your CPA or your investment broker. Additionally, the issuer may even evaluate an individual's credit report just to make sure they are in fact accredited. But you don't necessarily have to send all these documents to the issuer of the security if you're not comfortable. Most of the sophisticated sponsors usually accept third-party accreditation verification. So it could be like a letter from your CPA or financial advisor, or there are a ton of online services like Parallel Market, Early IQ, or even verifyinvestor.com, where they have an online portal. So you just make an account and you upload all these documents. Everything is confidential and super easy, and these services will send the accreditation letter to the fund sponsor. It is, of course, both your responsibility to represent yourself truthfully when opening a financial account, as well as the financial company's responsibility to do a complete due diligence to ensure that you in fact are telling the truth. So this means that, let's say, a non-accredited investor loses their money on some complex financial instrument, they may be able to recover some of their losses even if they lied about their status. Watch out for my next video in the series explaining non-accredited investors and what type of investments they have access to.